Are more people today realizing the need to be personally responsible for retirement and long-term care? What would your retirement and long-term care picture look like if Social Security and/or Medicare and/or Medicaid benefits were to significantly change? Unfortunately, many Americans have no sources of guaranteed income besides Social Security. Therefore, can a non-qualified annuity be a beneficial financial product in providing guaranteed income in retirement and mitigating the risk of outliving one's assets? What exactly is an annuity? Why should someone consider purchasing an annuity? What are the different types of annuities? Do income annuities deliver retirement security and peace of mind? What common mistakes do people make when selecting an annuity? What costs and expenses are associated with annuities? What is the meaning of the term surrender charge? Are annuities rated, and if so, by whom? What is a free look provision? Hello, my name is Attorney Ramsey Bahrawy, and welcome to Your Money, Your Life. In this segment, we will discuss the role annuities may play in your retirement or long-term care plan. To assist me in this discussion, I've invited Steve Stanganelli of Clearview Wealth Advisors to join me. Steve, it's great to have you back on the program.
Ramsey, always good to be here.
Pleasure is all mine. So listen. First of all, the European sovereign debt crisis is back in the news. Interest rates are extremely low, probably going to stay low. And then we've got a stock market that's extremely volatile. What is someone who's nearing retirement or in retirement to do if they're trying to develop an income stream? Are there any solutions?
There are a lot of solutions, and I think part of the problem is that there are so many solutions that individual consumers can be overwhelmed.
I see.
I think that the first thing that an individual consumer needs to do is look at what their specific needs are, not look at what their neighbor has or needs. What you really should focus on is what your investment needs are, and how you do that is calculate what your lifestyle costs are, including health care, including long-term care, and try to budget into that all the other resources that you have.
Okay.
Possibly a pension, possibly Social Security. We hope that it will still be here.
We hope
go
so.
Forward.
Yeah.
Pensions, not so much for a lot of folks. Yeah. And then the third leg of the stool, personal savings. And this is where things like annuities can fit in, along with other investments. But when you asked specifically, how does someone deal with fluctuations in the market, interest rates that are near zero, well, the key here is to have a diversified portfolio that can provide some safety. Shifting all the way to bonds or cash or money markets is as equally bad as shifting everything into stocks. So we really do recommend that people have a good solid mix, and in these times when people are trying to supplement their income from these types of investments, don't just look at bonds, don't just look at CDs. There are things like dividend-paying stocks which can add to one's income.
Okay, I follow what you're saying, and to some degree I agree with you. However, let's consider for a second the psychology of the person.
Yes.
With all this volatility in the stock market, with interest rates being so low, it is just normal for people to start shopping for rates.
Absolutely.
Right? They start looking around. They don't look at anything else but where can I get the best return? Unfortunately, when they do that, they start taking on more risk than they should, though.
And they also forget about all the strings that are attached to that.
Okay.
Now, we would recommend in our services with our clients, we would go through all of those choices and the balance of the risks and returns between that.
And to follow up on what you just said, I personally think that a money market account, a certificate of deposit account, investing in high-quality bonds, I think that's a great place, given what's going on in our economy, to park money. But you're not going to get any significant return. No. Okay, so if you've got money that you're going to need in the next 2 or 3 or 4 or 5 years and you need to park it, I'm all for it. Put it in a CD, put it into a high-quality bond fund, or purchase the bond outright. Right. But if you're looking for an income stream, which is what we're going to get to here, perhaps the annuity is the way to go. What is an annuity, though? What is it?
An annuity, most people are familiar with Social Security. An annuity is simply a contract where you receive a stream of income. In this case, a private annuity offered by an insurance company. Most people are familiar with their pension or Social Security, which is also a stream of income.
Okay, so the annuity provides a stream of income, but with interest rates so low, isn't it going to take a lot of money that you're going to have to put into an annuity in order to develop a stream of income?
Conceivably, yes.
Yeah.
We certainly recommend that individuals structure their investment portfolio in buckets, so to speak. Because there is always the potential of inflation and the potential that someone who is retired, someone who is hitting the age of 65 has, on average, to look at 85 as being the potential date that they have to live through. So they need 20, maybe 30 years worth of income to sustain their lifestyle. So to abandon the stock market is not entirely wise. So that's why we would recommend this bucket approach where longer term assets would be invested in high quality stocks, dividend paying stocks, things that can counter inflation. And then we would use an approach where we would dip into that bucket and draw money into a shorter term bucket, which would fund an income ladder. That income ladder could consist of CDs and money markets, but certainly fixed annuities and other annuities as well. There are various types of annuities.
I was just coming to that. Can we talk a little bit about the different types of annuities that exist, and how are they different?
Well, essentially there are three main categories of annuities. You're looking at a fixed annuity, a variable annuity, and the hybrid and indexed annuity.
What's the difference between those three?
Simplest and easiest to understand. There are very few moving parts. It is essentially an interest rate that is credited towards that account. You put your money in for a certain period of time, and you receive that money at the end of that period. It's analogous to a certificate of deposit. It's not quite the same, but it is the most easily compared to that. When you're dealing with a variable annuity, that's one where individuals put money into an account, and there are sub-accounts, very much like mutual funds, which the individual can choose or have an advisor choose for them, that would then potentially earn a higher rate of return. And ideally, if it earns enough, you are then drawing off of a higher base for that retirement income. The third one is a little bit more complex.
Okay, and the third one is the index annuity, and why is it more complicated?
Indexed annuity, as I said, the term hybrid, because in many ways offers very much similar characteristics of both. There is a fixed feature to it, but you also are tied to the performance of a particular market index, whether that is the S&P 500 or NASDAQ or some international index or some combination. Essentially what you're doing is, and many people will tend to use this as a CD alternative, and you'll invest the money. The insurance company will keep the money there for a period of time and then credit you a certain amount of money based on the performance of that index.
Let me get to what to our viewers is probably the most important question, and that is, for whom is a fixed annuity most appropriate? What kind of person?
Well, you mentioned clearly the issue about investor behavior, and that really comes down to, if you want to sleep well at night, you would use these types of tools to help you guarantee that portion that you need to maintain the minimum level of lifestyle. Again, I would not recommend putting all of your eggs in one basket. It's never a good idea. So essentially what we're suggesting here is you have that portion above and beyond your minimum amount for living expenses. So you know what you're roughly going to need for living expenses for the next several months. That would be something that would be more appropriate for money markets. Then beyond that, then you can create a ladder.
And to be very clear, on the fixed annuity, the payout to the individual, to the owner of the annuity, that's guaranteed by the insurance company.
Claims paying ability of the insurance company. So yes, and one thing we would suggest is for individuals to diversify among insurance companies. I
was just going to get to that, because insurance companies are rated, and not all insurance companies are created equal.
No.
Now, do people make mistakes when they seek to invest in annuities? And if so, what kind of mistakes do they make?
The typical planning traps for those people who are unaware relate to not understanding what they have. They don't read the contract. That's really the key issue. Focusing exclusively on the yield as promised by the insurance contract means you're blinded by what else might be going on. The other issue there tends to be bias in the sales channel. You have to understand the source of who's offering you this information. If the individual's making a commission on that, they may be more inclined to recommend a particular type of product that has potentially a higher payout to themselves as opposed to the higher payout presumably to the consumer. And the other issue is that they can be extremely complex contracts. Unlike a certificate of deposit, which most people can really simply understand, you simply put your money in and you get a receipt and you move on.
Now, what is the free look?
The free look provision for any insurance contract allows a consumer to invest, open up an account, open up a contract, and then change their mind and receive their money back within that period of time.
Okay. Now, surrender charges. Annuities come with surrender charges.
Yes.
What are surrender charges and how do they work?
Again, I have to go back to the analogy, which is certificates of deposit. Most people are very familiar with that. You take your money out and a penalty may be assessed on the balance if you're taking it out before the maturity date. In many respects, the same thing occurs with regard to an annuity. Most annuity contracts do allow some portion to be withdrawn before a maturity date. Typically, it works depending upon the contract. It can be a declining scale. So it might be 5% in the first year, going down 1% every year until the 6th year when there is no surrender charge. I have seen some annuity contracts that have lasted 10 years or more.
Now, given the wonders of modern medicine, people are living longer today. So for what period of time should people be planning their retirement? I mean, you know, once upon a time, when Social Security was first enacted, we'll start with then, nobody was expected to reach 65.
That's why it was a very solvent system, because the average person who retired at the age of 61 or 62 may live 2 or 3 years beyond that, and you started receiving benefits at the age of 65. So it was a very, very solvent system. For a married couple that reaches the age of 65, there is a 50% chance that one of the partners will survive into their 90s. Actuarially, the average age tends to be somewhere in the mid-80s for women and slightly less for men. Generally, the thing that we would suggest folks do is go to the Social Security website. There is a longevity calculator. Some insurance companies also offer these, where you put in some information about your family history, your medical history, and it will give you an idea of, based on your lifestyle and choices, what your expected life would be. We generally, in the insurance industry in general, will tend to look at age 90 or 100. So, as I said,
so you're talking
30 years potentially.
You're talking
retirement.
minimum of 25 years.
Yes.
Okay.
Again, going back to the point why it's very important not to abandon putting money into some type of equity, because that's really historically been the only thing that has outpaced inflation. So variable annuities on average will tend to be close to 3%.
Now I'll share a personal opinion with you. I think that the reason why people will prefer dealing with an annuity company, an insurance company that has an annuity product, rather, let me rephrase that, is because they don't have to think about it. Right? I mean, if you're going to build your own ladder, I'm going to quote you, if you're going to build your own ladder of bonds and stocks, dividend-paying stocks, and I happen to agree with you, I think that's the way to go. But you got to think about it. You got to think about, okay, what am I going to buy, and in terms of the stocks, you got to know what company you're buying and how solid and how solvent that company is, and whether that company is a big player in its industry. There's a lot of things that you have to think about. And then if for some reason the company hits hard times, you got to think, is it time to sell? Is it not time? You don't have to do any of that if you're involved in a mutual fund or annuity, right? You just hand your money over and you let them manage it. You let them do it. So I think that is the attraction of those products. You don't have to think about it.
I think that the individual needs to think about it from the very beginning in all of these things. No one thinks about your money more so than you as a consumer.
And I totally agree with you. Nobody's going to look out for my money as closely as I am.
That's right.
Okay? Nobody is.
And part of the issue is the type of due diligence is different when you're dealing with an annuity or even a mutual fund.
These are trying times for retired people who are attempting to develop a livable income stream from their investments. It appears interest rates are about as low as they can go and likely to stay there for the foreseeable future. This makes cash and high-quality bonds a safe parking place, but little more than that. In the meanwhile, the volatility of stocks signals caution, especially for anyone with less than a 10-year time horizon. Amid such a challenging environment, would fixed annuities be a safer bet despite its higher cost structure and lack of liquidity? The rules governing these insurance products can be complicated, and a mistake can have serious consequences. Remember to read the contract carefully. All annuity contracts are not the same. In fact, annuity contracts vary. Know your beneficiary arrangement. A feature that makes annuities attractive is their ability to bypass the probate process upon the death of the owner. However, this requires selection of a beneficiary other than the estate. So make sure you name specific people as beneficiaries, such as a spouse, children, other family members, and/or friends. Also make sure to name a contingent beneficiary in the event the primary beneficiary passes away. Make sure you fully understand the risks before entrusting any of your hard-earned cash to annuities. For as Ben Franklin is quoted as saying, an investment knowledge always pays the best interest. Therefore, learn about annuities before you invest. Understand which type of annuity is best for you by considering your risk tolerance, time horizon, and financial goals. And make sure that an annuity complements your estate plan. Why? Because it's your estate plan that acts as a roadmap to guide you to achieving your goals and objectives both during your lifetime and beyond. For retirees, a fixed annuity may offer the assurance of a stream of income for life or for a specific period of time. For some, this guarantee may warrant the increased investment costs. And lastly, make sure that you avoid the common mistakes highlighted by my guest Steve Stanganelli, such as failing to understand the fine print, shopping only for published interest rates without regard to other criteria, and failing to perform due diligence. In closing, thanks to my guest Steve Stanganelli for participating in this program. Thank you, Steve. And as usual, thank you to you, our viewers, for watching Your Money, Your Life. My name is Attorney Ramsey Bahrawy, Building Your Trust.